If you just look at those numbers, 47% of 18 trillion, and just assume that 10% of that is invested in gold, that works out 11,000 tons. 11,000 tons this year, next year, the year after, whatever. Right. So you can see, that there is a huge underlying pressure because investment alternatives are unattractive or less attractive to the Chinese. We have to modify that figure, actually.
In today's episode, Alasdair Macleod shares his silver price prediction, as numerous experts are predicting $50 in silver very soon. In this video, he'll explain the main fundamentals that are driving the price of gold and how he thinks the whole situation will unfold. If you're into gold and silver, this video is for you. Smash the subscribe button, hit the like button, and enjoy the episode.
Household savings work out at considerably less than that because it is part, if you like, of the total savings number. And I calculated that, again, 10% of those, if that was put into physical gold, at current prices, we're looking at 3,000 tons. Now, that is roughly global output. And it means there's nothing left over for savings. There's nothing for anyone else in Asia to buy, like the Indians and, the Saudis and, all the rest of them, the Russians as well. So you can see that, suddenly there is quite an appetite there. Now, on top of that, there is another factor, and that is that while the Chinese are enormous savers, I mean, we're talking about, in this sense, they're taking a long-term view. They are also the maddest punters in the world. I mean, they love to have bets. They love to, sort of speculate, if you like. So, you've got the guys with actual money, thinking, right, where are we going to really make money? What can we bet on? And if they're not betting on the number of lumps in a sugar bowl, they go into the futures exchanges. And of course, that means that the banking system, the bullion banking system, as it were, ends up short futures on the Shanghai futures exchange, which it has to cover elsewhere. And we see this going through London. We see, when there's been sort of big demand overnight in Shanghai, you find that in the run up to and around about the time of the London morning fix, gold is going up. But also it spills into COMEX as well. So you see that, when that opens too. So this is a factor which is not going to go away. I mean, I think this is the point. You've got this underlying demand. And at the same time, I mean, the Chinese individuals, let's say the sort of financially literate or the relatively financially literate Chinese individuals see what the central bank is doing. The central bank is selling dollars. And what does it buy? Does it buy another currency? No, does it? Hell is like. It goes out and buys gold because they know the difference between money and credit. And they have a policy of winding down their involvement with dollar credit and, for that matter, euro credit, yen credit, whatever, but particularly dollar credit. So, when people say that the Central Bank of China, the People's Bank of China, is buying gold, they've actually got it the wrong way around. It's not buying gold. What they're doing is they're selling dollars. Now, guys in China who, sort of actually analyze these things and think about it, they understand that. So this is a story, if you like, that is spreading throughout China. Sell dollars. Quite simple. That's what the central bank is doing. And if you want to make money, then, okay, you can't go out and short dollars, in China because you've got exchange control stuff and all the rest of it in the way. Well, one thing you can do is to buy what the central bank is buying as it sells those dollars, because you can see that the central bank has still got a hell of a lot of dollars to get rid of. And if you look at the government, I mean, they've got something like, I don't know what the total dollar position is. It's going to be in the trillions. But of that, roughly 700 billion is invested in US treasuries. So they'll be selling those as well. And the idea that the US government can fund itself with the aid of foreigners. That's going away. That's not going to happen. I mean, it really isn't. The largest identifiable holder of US treasuries is a seller of dollars. So they're not going to be buying treasuries. That is for sure.
As global economies grapple with uncertainty and inflationary pressures, silver is emerging as a bright spot for investors. Recently, the precious metal has seen a significant uptick in demand, particularly in China, where thousands have been reported clamoring to secure physical assets. This surge is not just a momentary spike, but reflects a broader trend of increasing interest in precious metals as a hedge against volatility. Financial analysts are increasingly bullish on silver, projecting potential price increases that could redefine market expectations. With gold reaching historical highs, silver's relative affordability makes it an attractive option for both seasoned investors and newcomers. This appeal is magnified by the metal's dual role in both financial security and industrial applications, which could drive prices to unprecedented levels in the near future. However, the enthusiasm for silver and its prospects comes with cautionary notes. The rush to invest in precious metals is indicative of broader concerns about the stability of traditional financial systems and currencies. As governments and central banks navigate these turbulent waters, the move towards assets like silver underscores a shift in investment strategies towards more tangible stores of value. This trend suggests a pivotal moment for the markets, where the allure of silver could lead to a reshaping of investment portfolios worldwide. Now we'll show you more clips, but first like and subscribe so you do not miss out our daily recaps.
World, and what he says you need to listen to very, very carefully. So, in the past, I've quoted him equally in support of in support of my analysis. But in his letter to shareholders with the 2023 accounts, which were released, I think, sort of just a week or two ago, he said that he expects volatility in interest rates, and he said they could go to 8% or even more. Now, this is he's also saying stagflation, using those terms, and producing exceptional risks to the bank, and so on and so forth. Now, I mean, what he's clearly saying is that interest rates are going to go up. And he is going to try and reduce his exposure to risk. And this is the largest and the most important commercial bank in the world. It is the commercial bank which is the Fed's conduit into the market. Yet we're all sitting here, I mean, the majority of us sort of Keynesian economists, saying, we face a recession. Okay, we can admit that because you just look at business conditions and all the rest of it, and it's not all that good. I know that GDP figures look sort of better than expected, but basically, things are not all that healthy underneath. We are probably heading into a recession, and that means lower interest rates. No, it doesn't. What it has done in the past is that it has led to a crisis in lending, which requires interest rates to rise unless the central bank comes in and really suppresses rates in order to rescue the banks. And that basically has happened with every recession since the early 1980s. I mean, you could just look at the chart of interest rates in the United States, overnight rates or the Fed funds rate, the St. Louis Fred puts in recession bars and all the rest of it. And every time one of those recession bars is there, the rate is falling. This is because the central bank is suppressing the rates. We're now in a situation where, after decades of suppressing rates, the level of government debt has risen to astronomical levels. They can't suppress the rates anymore. And so you made a comment about debt. This is the importance of this debt, if you like, in this situation. The central banks have lost control of interest rates. They cannot suppress the rates anymore. Because the whole point about suppressing rates is you want to inject more money into the economy. That's the Keynesian idea, to try and rescue the economy. All you're doing is you are hampering the evolution of the economy, because the point about a recession is that it drives out businesses which are no longer profitable. It reallocates capital to entrepreneurs, if you like, with new ideas, better products, better services. And that way you get economic progress. But of course, economic progress is not something that you can measure. You can only measure the amount of credit being deployed in the economy. So if you puff up the credit, you create the illusion of economic growth. But actually, all that is going into bust industries, which should go bust, but are basically continuing on the lifeline of suppressed interest rates. That is coming to an end. And if you want an example, I mean, well, you can see this in the US, but it's absolutely as clear as anything if you look at the Japanese situation. I mean, and also the Eurozone situation, where the suppression of interest rates took them into negative, into negative overnight money. I mean, it's just absolutely crazy. Now that interest rates are rising, I mean, they've started rising properly in the Eurozone. There are going to be many bankruptcies there, and that's going to threaten to undermine the Eurozone, the Euro system completely, and could even lead to the end of the euro. I mean, I think we're running out of time on fiat currencies anyway, but you can see there is a specific danger which the euro faces. And if you look at the Japanese government, I mean, ever since the stock market crash back in, 1990, 1991, the Japanese government has been running deficits. I mean, occasionally it's been as bad as 10% of GDP, but it probably averages around about 6.5%, maybe even 7% of GDP for all those years, year in, year out. It's a bit less than that now, but don't think that they're getting their books straight. And who owns all this debt? I mean, basically, it's the monetization of that debt, which has been part and parcel of keeping the interest rates suppressed. And the monetization of it has been by the Bank of Japan, which now owns 60% of all Japanese government debt. And they've got a debt to GDP ratio in excess of 250%. I see in the last couple of years, it seems to have declined from about 271%. So I think there's a bit of funny accounting going on. But anyway.
What do you think of Alasdair's take? Is he spot on, or is this another all is air thing? Post in the comments section down below your honest opinion, and share this video right here because it's a perfect fit for you.